All right, stocks continued their little hiccup that they've been going from last week going on to the new week, but it wasn't quite the hiccup in the NASDAQ. So I'm going to break down the pattern that we're seeing in the NASDAQ and what that would mean if we saw the same pattern in the other indexes, especially the S&P 500. So we're going to look at the differences in those major indexes to see what if there's any red flags showing up, what they are, what they mean, how significant they are, how likely we are to start any kind of more selling than what we've seen, or are we likely just to bounce up from here? So we're going to look at what I think is going to happen and why. We're going to break down what's driving today's price action. There's some pretty significant extreme moves going on and among different asset classes and sectors. So we're going to break that down. And then our today's trade idea is a stock that's in a kind of familiar space where we've been doing a lot of recent trade ideas. This kind of reflationary trade. We'll talk about how to trade a stock where we're bullish, but we don't really have as much upside as we think we may have, especially in some of the other trades that we've been doing. So let's go ahead and get started. Today is Monday, February the 22nd, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator and see how today's selling. So fifth day in a row to the downside and breaking the 23% retracement line of the near-term rally. So still easily between the 0 and 23 of this intermediate run, the dark green shading and the green line run. But this last rally here, this little near-term blue line rally here, that's this move. And so we are now obviously retracing that move. The question is, how far down will we go? And we're still easily above support. Like there's, it's not like we're breaking through the Fibonacci retracement zone here. This 5-day losing streak is about as bullish of a 5-day losing streak as you could possibly have. Hardly any downside at all. But we did break through the low that's in between these divergent highs, and on the divergent high we had a cluster, an overbought cluster, and we have a little bit of a red flag, just a little one, from a short-term sentiment standpoint, because it always starts there, and that is this oversold momentum line. This is the first time we've gotten an oversold momentum line since way back at the very beginning when the VIX was really volatile. Right now, you can see the near-term line didn't drop yet, and that's kind of the next. That's why I say it's only a little red flag. The near-term line still hasn't dropped into the reversal zone since way back over here. Since this whole intermediate run started, we haven't had the near-term line even dip its toe under the water, so to speak. Much less get significantly down here. So we're still not quite there, though. That's still a pretty decent decline on near term coming off of this divergence and then breaking through the lows of the divergence. But we're still above the 30-day moving average, so it's not like we're really falling off a cliff. And we still have dark green shading. We don't even have the light green shading yet. From a Dow Jones Industrial Average, you can see how sideways. Look how sideways we are. We're really not going anywhere. That's kind of what I've been mentioning. A lot of people talk about why would you have any kind of hedge on right now from an active trading standpoint. It's because my upside is limited. Look at that upside, limited on the Dow. My downside's not. Look how quick and easy we fell down during this still drop. But on the subsequent up, we bounced up pretty quickly back to the old highs, but then it couldn't go anywhere. So the upside's limited because of how bullish we are. The downside's not so limited. If you look at the NASDAQ 100, it's also getting a very extreme low on the momentum line. Near-term line is not quite an oversold level either, and we actually got a light pink shading and a yellow line, and that's not a very deep drop. If you look to see with this PPO pattern here that we use at Market Scholars, you can see from how far down below the 30-day simple moving average we are. We are down. What is that? Less than 1%. So 1.5%, probably about 2% is where you really start to worry about things on the NASDAQ because it's a higher beta. But we're only less than 1%. So there's still a good chance here. And you can see even on its near term, we had broken its 23%. And now we've gone all the way to the bottom of the retracement zone of this near term rally. This level right here. Let me edit this and turn it blue so it stands out with the market forecast line. So there we go. And then this line here, we'll just remove that drawing and then move this up to that high point there. All right, so there's a 23% retracement of the intermediate run that we're on, and this is the current near-term rally that's obviously have ended. But I mean, there's a very good chance we bounce off of that. That's a very bullish pattern. Now remember, every intermediate pullback starts with light pink shading and yellow lines, so that it could still turn into something more. But as of right now, I would expect that to bounce and bounce off of that. We don't have yet. We're still, even in the Russell, we're not even close to its 23% level. And if you look at the Nasdaq from an intermediate standpoint, so this whole run right here, we are flirting with its 23%. That's at about, where is it at? It's at the 13,182 level, and we're trading at 13,223. So we're about 40 points away from flirting with that level and starting an intermediate decline. That would, the near-term momentum line tells you that we could be headed there. The near-term line's not quite. If you look at how big today's move was, you can see from SPY, we didn't have a significant gap. I would have been worried if it were like maybe 1.5%, but it was about half of that, about 0.75%. We did finish down about 0.5%, but not to the 1%, so not really any significance there. But if you look at the Qs, that was a pretty significant drop, a 2% decline. Now the last time we had a 2% decline, we bounced up pretty well. But a 2% decline there on the Qs coming off of what was a pretty significant gap to the downside. So the Qs is suggesting, that's a little bit of a red flag that if we don't bounce off of on Monday or tomorrow here, then that might be the canary in the coal mine, so to speak. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know that you liked our video today and that you want us to do another video again tomorrow. Quick way to give us feedback. If you like our videos, of course, if you don't like our videos, you don't have to click on anything. But if you do like our videos and you want to let us know, you can do it with one click right now while you're watching. Also, while you're down there, comment. What did you get out of our video today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click that link. You can subscribe to our site for free. You get access to our Market Outlook forum, our message board for Market Outlook viewers on our website with your free subscription. Also, follow me on Twitter for more content in between the videos. There's my handle right there at DavidSettle42. And then finally, join our Market Outlook Facebook group that we've created. If you're checking out our video here on our blog, check out our classes over here on the right. All of our premium and our plus subscribers get access to all of our trading rooms. Our premium subscribers get access to a lot more for actually less money per month. But at least our month-to-month subscribers get access to all of our trading rooms as well as our Market Outlook Live. I always get asked, hey, can you talk about that trade you did? Well, I do. And every day I do the Market Outlook. I also do a separate video, a live video on YouTube where I talk about all the trades we've done and we see if we should stay in them or get out of them, and we continue to manage them. So check that out there. You can click on this little icon, or you can also come right here to the Trade Review Archives by clicking on that link. Come down here, click on this heart. It opens up a new tab. Hit that like button right there. Also click this thumbs up. It opens up another new tab while you're at it. Hit that like button again. The more people that do that, the more people will see our content because of all the likes and engagements it has and comments. Also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most, especially Facebook, which doesn't really promote business pages, but will if you engage with them. They'll promote that in your regular timeline. All right, let's get back to the charts here and take a look at what we're seeing. And you notice that we have a transition candle again. We talked about that in Friday's Market Outlook video. There's that transition candle. If you look at the Nasdaq, it's even worse. It's actually a bearish candle developing on the Nasdaq. Now the week's not over. We're only one day in, so we'll kind of slow our roll a little bit. But you can see how high the momentum is for the Nasdaq on a long-term base. Whoops, sorry, did not want to do that. How high that momentum is. This indicator tells us on a historical basis how high it is. We're in the 85th percentile of the last 3 years. Going out the last 20 years, we're in the 93rd percentile. So we are pretty darn high right now. We have been this whole time. In fact, this is the only time we've been above the 90th percentile. This whole rally on the NASDAQ, this post-COVID strong momentum. Again, at some point in time, we're going to be breaking down here and filling in the gap between the 50 and the 200-day moving averages. And you can see, whereas we didn't quite get, let's do this so we can see things a little bit better. And then we'll use the log scale. There we go. So, we didn't quite get the transition candles here like we did in the S&P over here. It's, we're pretty bullish, these long upper shadows, but now for the first time we kind of are. So we'll kind of keep our eyes on that and see how we finish this week to see if we end up with a bearish candle on the S&P too. From a 3 green arrow standpoint, we have one red arrow now. We had that one. We're getting closer to some of the others. From a 2-line version, this is what it looks like. The MACD is obviously down below its moving average. So is the stochastics. It just hasn't crossed below 80 yet. And you can see, as bearish as we've been, 5 days, we're still sitting right on the 17-day moving average. So if we bounce off of this, great. That's the S&P. If you look at the Qs, remember we got the light pink shading the yellow line. So, we either bounce back up above the 17-day like we did there, or we start to turn back around again, and that's the concern. I mean, we are more bearish now than we were there the last time we had light pink shading in the yellow line, at least on a MACD basis. So again, it shows how kind of pivotal tomorrow is. I kind of expect that we'll bounce off of this tomorrow, but it shows just how pivotal, how pivotal things can be. If you look at the DMI, the negative index bouncing back up above 25 with the positive index dropping back below 25. That's again on the S&P. Look at the Qs and look at that. Big jump in the negative index up above 30, and this time the positive index is below 20. And so that's a bearish breakout pattern. We didn't get that over here. See, over here the negative index jumped up to about 31, but the positive index had barely dropped below 25. That's not the case right now. Now we are getting above 30 and below 20. Again, nothing's 100%, but that's a little concerning there. You look at the RSI and the CCI, you can see breaking below the midpoint, but not yet on the RSI, on SPX. But if you look at NDX, we are breaking below the midpoint on the RSI, and we're dropping sharply below negative 100 on the CCI. So that's telling us too that the NDX is in pullback mode, right? Even if it hasn't necessarily broken that 23% retracement quite yet level, but it's close, right? It's the closest one. It's the index that's by far the closest. Look at the trend strength. You can see we're losing trend strength on SPY. Not so much. We still got some room to go. So again, very pivotal moment because we're below the blue line. When you get below the blue line, you can bounce right back up, and especially when you still have a very strong trend. So very, very pivotal moment for the NASDAQ. The Russell 2000 is so very strongly bullish. Remember how hard it is to break these very strong trends. When they break, right? They'll get to zero, but it's very, very hard, and we still quite haven't done that. That's why I still kind of lean towards making a move to the upside. Here's our break getting down to the 50% mark on SPY. Again, like I said, more bearish on the Qs, though. We are into that, flirting with that lower quartile below the 25th percentile. Remember, the Qs have a better margin of safety than, say, IWM does, which doesn't have a whole lot of volume. When you break that 23% level, and there's not very much volume down below it. So very, very important that we still stay kind of in a noisy range for all these other indexes, and then the NASDAQ kind of catches back up to where all the other indexes have stayed during the NASDAQ's kind of more significant decline over this past 5 days. All right, let's take a look at the intraday chart. This is a little telling too. You can see we gapped down, we filled in the gap, and then we finished down. So that's a little bearish, right? It's it would have been a good thing to gap down and then stay up. And then we're not so bearish anymore, kind of like we were over here, and really pretty much over the Wednesday and Thursday of last week. This is different because we gapped down, we filled in the gap, but then we didn't stay up and finish at the highs here. We rolled back over and finished down. If you look at the Qs, we really broke down. So we got what could be and this could be too, runaway gap, right? Where remember the gap to the downside and the close is a lot more significant on the Qs. So again, it's a little, and we also have filled in this gap from way over here on February the 2nd to kind of give you an idea of, the SPY, that's way down here. That's a move down to the 23% retracement for it to fill in that gap. And then for the small cap index, February the 2nd is right over here. It did fill in that gap that same day, but you can see how far away that one is too from where we're at right now. And remember, the small cap has the poorer margin of safety. It's a little easier for it to fall down, and it still hasn't filled in that gap from Friday morning. But the volume today, still not too bearish, right? It's still just barely above average, 67 million. And then the trading range was really, really light, right? It was 2.88 points, but a little bit of a gap there. So we closed at 390, the high at 389. So we had, about a half a point of range. So even with that 2.88, add another half a point, and that's not very much of a range there. If you look at the volume, 67 million, the trading range, under 4 points. So that's not too bearish of a move. It would have been more bearish had we been above 100 million shares. It would have been more bearish had we had about a 6 or 7 point range. So we didn't have that. So you can take a little bit of a breather, knowing that we're still okay, right? It's a little different on the Qs. We were 5.5 points in our normal range today. Then when you include the gap from 331 to 327, just under 328, so about just over 3 more points. So there we actually did have about 8.5 points of range. That's up here, right? So that was a pretty significant. And then if you look at the volume for the Qs, let's look at the volume on this chart for the Qs. You can see that was also more significant, 1.5 times. So again, like the Qs are giving us a signal that if we had on the S&P, we'd really be concerned. Not breaking the 23% level yet. We're still not quite there. We're still in the noisy range for the intermediate level. Here you can see it better if I show you on this chart. So we're still not breaking that 20. There it is right there. That's 23. We're not breaking that quite yet, right where my cursor is here. But man, we're really close. So it's kind of make or break tomorrow. I still lean towards we'll bounce up. It's really hard to break these strong trends that are still there in the S&P and the Russell, and for that matter, still actually here on the NASDAQ. But man, it's to the point where if it doesn't bounce up tomorrow, if I'm wrong on that, then the NASDAQ may be leading the rest of these indexes down. And I wouldn't have expected that, right? I still kind of expect the small caps to lead us down because they've led us up. And so that's another reason why I think the NASDAQ will bounce back up, because we're not seeing that broad participation in the sell-off, which is kind of crazy because, we've been talking about broad participation in the rallies, but we haven't really seen that broad participation in the sell-off. So to summarize, the posture is still strongly bullish, and especially across all the other major indexes. Some red flags, a little red flag in the short-term sentiment on the S&P, more red flags on the NASDAQ 100, but still limited to a small subsector of the market in that NASDAQ 100. So a decent chance that we'll just bounce off of that for maybe another near-term rally. Maybe not as long. We probably won't get a normal near-term rally. We'll probably start to get shorter ones before all is said and done. But we definitely need to take the signs that we're seeing on the NASDAQ a little seriously and see, if we don't bounce back up, see if that leads to a broader selling in the next day or two. Then we'll know that, okay, there's a good chance we're headed towards that exhale sooner rather than later. I don't think that's the case. I think we'll bounce up for the reasons I discussed, but we need to be aware that if we don't, then we need to be able to respond in our active trading. So what do you think? Do you agree with that or do you disagree? Let me know in the comment section below, especially if you disagree. Comment down there as to why. What are you seeing from a charting standpoint? What indicator or charts are you looking at that suggests why you're either a lot more bullish than I am or a lot more bearish than I am? All right, well, let's take a look now what's driving the price action. And this was a commodity-driven move today. You can see the dollar was down. The commodities rallied sharply up over 2%. Gold was up 1.5% on the weakness in the dollar. Long-term bonds were down, so that means yields were up. Again, that very inflationary, see yields going higher. And look at the downsides, right? Even with the weakness in the dollar, emerging markets got hammered. And that's even with strength in commodities, which they're typically tied together. So to see emerging markets getting hammered today, see QQQ getting hammered today, kind of shows, again, just a little red flag in terms of risk appetite. Let's take a look at some of these charts, some of these different asset classes. We'll start off with the dollar first, especially compared to the euro. We'll start off with that one first. And you can see how we've gone back through with today's move. We've gone back through the moving average. So not only do we have light green shading in the yellow line, but we're now dark green shading with today. Now this little candle just barely started, so we're only a few hours into that one. This is the one that completed today, and you can see we got back above this high point, but you notice we're still not back above that 23% retracement, which would signify that we're starting a new, that we're getting back up towards these highs and potentially start a new intermediate rally from there. Dark green shading and a green line is what starts the intermediate rally. The intermediate line is just crossing above 50. Strong short-term sentiment. We haven't crossed back above the market sentiment line yet. So it's something to keep an eye on if we break through that. Because again, that would be weakness in the dollar. And you saw the impact that that's having. Look at commodities. We got that cluster a few days ago. If you look at it on a weekly chart, what we're seeing, we got the cluster a couple of weeks ago. And we are just like really we're going through these old highs. We still haven't got to the this would actually be the pre-COVID highs. We're broken through that. We haven't gotten through the late 2018 highs when this bear market really started. So we still got some run to go, but just to kind of give you an idea of how far up above the 200-day moving average we are right now, and we'll use the 40-week exponential as our proxy for that. To kind of give you now, we're 18%. That's the highest in the last 5 years. So let's go out 20 years for most of this bull market coming off of the bull market peak that it had. This most bullish that it was there in 2008. And over there, as bullish as we were there, we were about 26%. Since then, even with these clusters and that really strong run we had in 2010 going into early 2011, we got up to about this level, right about 15%, and now we're at 18%. We're in the 86th percentile. Again, there is like the only point higher here was 18.35 was the highest point we got during that time frame. We're at 18.33 right now. So needless to say, we are very, very strongly bullish. And if we break the 17, 18 level, you can see we have a lot of room to go. So, this type of move would not be done if that were the case. If I were to go out all the way here on a monthly chart, and here, let's get rid of that expiring code and just look at the volume for DBC on a, I have to go DBC here. Look at it on this basis again. You can see this 18 level would be a very important level, because then the 26 would become our next spot, and that's the level where we got to before the dollar really took off in mid 2014. It's a really big gap in volume there, but before that we're going to get some pretty significant resistance here. And if you look at it just like say in the last 5 years worth of volume, again, that's where the top of the value area is. That's where we're going to meet up. And again, just as significantly bullish as that is, look how high the bandwidth. The bandwidth is about as high now as it was low during that period, and low there. If I go out further to try to get that, to get this 10-year, that 2011 time frame, you can see the bandwidth, which you can look at on an apples-to-apples basis. So when you look at like all these other levels were all bearish moves. This is the most bullish bandwidth, strong bandwidth that we've had, even stronger than what we had over there. So it's a very, very sharp move to the upside. We can't see it over there because we don't have enough time to go. In fact, let me see how much I got. Yeah, we don't have enough data points to be able to see where it was. But that's the only other time it's been this bullish on a Bollinger Bandwidth basis. So extreme trends right now. In fact, here, let's look at the DMI. Whoops, Ichimoku Club. Let's look at the DMI first in DBC. Again, look at that ADX as high as it is, and we'll go out 15 years. As high as that is there in a green level, mind you. It's been higher on bearish moves when things really hit the fan there in 2014. But we're at 54 right now, so that's the number we're at right now. And you can see it got that high there in 2007, going into its peak, it got up to about 60 on the ADX before we kind of went sideways for a while. And you see the positive index got up to about 45, and we're at 42 right now. And the negative index got down to about the 5th percentile, and that's where we're at right now over here on the right. So needless to say, we are hitting some extremes on the directional movement index too. Some very, very significant extremes with these clusters that are showing up. So, and that's also having an impact, right? It's an inflationary pattern that we're seeing, and it's also having an impact on yields. As you see, yields is really breaking through themselves and getting up to new levels and working their way up to closer and closer. And these got a long ways to run, but again, the PPO, which measures the strength of this momentum, we did hit a divergence there, but we're getting about to as high as we've been. Now, we were coming off of a much significant low point, so we have an opportunity to go higher. But it kind of gives you an idea that, especially with the golden cross is barely starting, you can see we're kind of in this mode right here, which means we may have a few more weeks before we get a test of the 200-day moving average on the 10-year note before we bounce and get going and on a more prolonged bullish trend, considering how parabolic we already are. If you look at the crossover here and then look at the PPO, the regular PPO, and then look at TNX again, and let's go out like the 15 years again. So again, you can see we're in the 95th percentile. These are the only other times we've been this bullish, and they've generally led to a test of the 200-day moving average. They both come right after golden crosses, and then we usually test before we continue the trend high. I think we're going to continue this trend back up towards 3% by the time all is said and done with this move. All right, now let's take a look at how the sectors perform on a day where commodities really blew things up and the Qs were down. You probably have a pretty decent idea of how the sectors perform. Look at that 3-month return for the energy sector. But let's just go to today alone, Energy up 3.5%. Financials up 1%. Utilities, discretionary technology really getting hammered and pulling the S&P down with it as a result. Utilities down too. That's not surprising with the rise in yields that we're seeing. Financials also not surprising considering everything else really flat. I think a lot of these are the rising yields are going to pressure the cyclical trade while the market still focuses on the quote unquote reflation trade. Right. I mean, you take a look at the Qs relative to IWM. That's still. I mean, look at the big drop down to new lower lows, well below 1.45. It's a pretty significant drop there. The 8 days below the 17 day. The MACD is rolling back down below its moving average. You still got some strong bearishness on the PPO, and you can see the CCI back down below -100. The RSI back down below 40. So we're still in bearish mode. It's still trending to the downside. And again, another reason why I still think that we're not necessarily turning back around yet, because again, my thought is, and take this for what it's worth, but my thought is the markets won't turn bearish until this turns back up, because I think this will make its way back up towards 2 by the time all is said and done. But on the initial turn back higher, it will be on a risk off move, because this whole thing has been a risk on move, which means it's going to correct itself initially in a risk off move for maybe a month or two before the Qs takes it higher, takes the broader market higher along with everybody else. Here's the charts. Look at that light pink shade and the yellow line. Look at XLY really diving below the moving average. XLC still holding up relatively strong, but energy up to new highs. Financials up to new highs. Industrials up to new 3-month highs. Materials getting back above its moving average. Healthcare bearish, dark pink shading and a red line. Staples, dark pink shading and a red line. Utilities really breaking down, dark pink shading and a red line while we're still here. So you can see there's some bearishness in some of these areas and bullishness in the others. And again, that's the trade that we've seen for the last so many months, and we'll expect, we won't get a change in sentiment, broad market sentiment, until we see a change in that relationship. It's, that's charted here. And this until we see a change in this trend, we won't see a change in broad market sentiment. All right, that brings us to our trade idea of the day. So let's take a look at CSX, another one of these industrial names that we've been doing a lot of here lately. These quote-unquote reflationary trades. You can see the intermediate posture is turning dark green shading. We got a green line, flirting with the green line there, kind of back and forth, flirting with breaking back above its intermediate posture. Good, strong, bullish near-term trend going on. We got 3 green arrows on the chart, a new 3 green arrows. Good, strong momentum and a strong stochastic indicator. This is what it looks like on the 2-line versions of the charts. That stochastics is rising again. We're getting the beginnings of a directional move showing up. You can see that positive index breaking back out above 25, the negative breaking below 25. So very, very beginning inklings of a directional move starting. You can see we're back above the point of control. We're at the top of the value area, flirting with breaking through. So, and again, to have the point of control below us is a good thing. So I'm not too directionally bullish, but when you got good strong support below you, it sets you up to do a good bull put spread at that support. So selling the, at the time it was a mid-30s delta, but selling the 91, buying the 89. So we're down just a little bit since we got into that, but that's our trade. And then that break even ends up being right at that point of control. So as long as we stay above the point of control on this new bullish trend that we're on, the upper quartile in the bandwidth, great. Right, with rising bandwidth, that's a great thing. But if it doesn't, then we'll limit our risk to, looks like we made about $420 getting in on a normal position size. So out of that 980 that I can lose, I only want to be willing to lose 420. So I'll buy back those 91s and sell the 97. And it looks like we have to get the 420 tomorrow. Actually, we'll do this. Reset parameters. There we go. So to get to 27, 420 tomorrow, we'd have to get to right around this, looks like 87.32 level. So that would be down into this area. So we'd be significantly breaking below that point of control and down into the lower quartile of the bandwidth. If we're going to, and the market forecast would show a change in pattern as well. That's what we would see if we're going to really break down here. As you see, the long-term trend is maintaining a good strong bullish, rising 50-day, bouncing up with a bullish candle on a rising 50-day moving average well above the 200-day. So good strong trends going here. All right, so that does it for me. You've heard from me now, and now I want to hear from you. Use that link popping out top right corner of your screen that takes you to our Market Outlook forum. Open up any new threads there. Remember, all our subscribers, even our free subscribers, get access to that forum. Let's keep this conversation going. What thoughts did you have? What do you see? And comment on anyone else's threads as well. Remember to hit that thumbs up icon and like our video today on Twitter and Facebook as well. Subscribe to our YouTube channel and comment on the video. Thanks again for watching. Have a great rest of your Monday night, everybody, and we'll see you all next time.